Hello, everyone. Good evening and welcome to Pearls of Wisdom with me, Ava Andabash, right here on Nirmal Bang. Today, we put the spotlight then on none other than Lemon Tree Hotels. It's India's largest hotel chain in the mid-price segment. It operates under various brands such as Aurika, Lemon Tree Premier, Hotels, Red Fox, Keys, Prima, and many more. We want to understand the demand-supply dynamics, what the outlook is on average room rates, occupancies, and how the hospitality and travel industry is booming and thriving. We have joining with us then on the show right now, Chairman and Managing Director of Lemon Tree Hotels, Mr. Patu Keswani. Thank you for taking time out, and I want to just get in a sense from you as to what the overall outlook is then, because we're looking at the travel sector really booming. I mean, if you look at the airports, they're jam-packed, hotel rooms pretty much booked out across the board. Is that really a trend that you foresee continuing for the coming quarters?
Hi, Evan. Thank you for this interview. Coming to trends, see, I think if I just look at it this quarter is somewhat affected, that is May, by the election year. And it is also partly affected by extreme heat. But on an overall basis, there is, I would say, a flattish growth vis-a-vis the last year same quarter. So the improvement that one would see, for example, in the hotel sector would be on pricing over the previous year rather than on increase in demand. And that is, as I said, led largely in May because of elections. Okay. How does one look at it? In June appears to be better than last year June. So I think on an aggregate, this quarter will be at least as good as the last year in demand and maybe a little better. But the following quarters, I think, will be much better than the previous year, because I think we are in the middle of a structural uptrend as far as travel and tourism goes in India. And I'll tell you the reason for that. I still think it's early days, but India is at a very interesting inflection point today. It is roughly where, if I look at the GDP per capita, or more importantly, the GDP per household, because that is the way we track consumption. We are roughly at the point where China was in 2006 and Indonesia were in 2007. So two countries. In fact, this applies also to other countries that grew from emerging economies into developed economies, or middle income economies and then developed economies. So I'm taking the last two examples, which is China and Indonesia, which was 17 and 18 years ago. And when they were at this point in the GDP per household, for the next 6 years, increasingly large numbers of consumers started treating travel and tourism as non-discretionary rather than discretionary. So let me give you an example. Typically, demand growth for, say, hotel rooms used to be 8 to 10% in these countries till they reach this inflection point, after which for the next 6 years, demand growth for, say, hotels was north of 20% a year. So traditionally in the hotel industry, for the branded hotel sector, demand growth is 1.4 times the rate of growth of real GDP. So if real GDP, say, grows at 6%, then you can safely say that demand growth for hotel rooms, branded hotel rooms, is 8 to 10%. And that's what's been the case for the last 15 years. But at this inflection point of GDP, which is, say, like India is roughly, say, $2,500 per capita and, say, $11,000 per household. Then if you look at the bell curve of GDP, that is the number of households that are earning over, say, $35,000 per household.
Right.
Those, when the economy now moves beyond this inflection point, the number of people who move into $35,000 per household and higher starts growing exponentially.
Okay, no, so Mr. Keswani, I want to come in here and understand what exactly this translates for you at Lemon Tree Hotels. In terms of the average room rates, that has improved on a year-on-year basis. Do you see that continuing to grow? What is the occupancy level that you're working with right now, and how do you see that trending?
So if you look at what I said, that in the past, see, there are two ways. One is to talk about the past and forecast, and one is to go a predictive route and say what is happening in the economy and will what has happened in the past continue to happen in the future. That's the question. If I looked at the last 15 years, every year demand growth was 8 to 10%, and on that basis, it was a function of how much supply was being injected that dictated occupancy. So if there was a supply growth 12% and demand growth 8%, then obviously the dynamics of the business is such that there was more supply than demand, and therefore pricing would not really go up, nor would occupancy. This was the case in the last 10-15 years. This started to change in the year before COVID. Then COVID obviously interrupted this trend, and this came back to normal last year, and that's why you started seeing every quarter an improvement in occupancies vis-a-vis the last year's same quarter, because this is a cyclical business. You should compare quarter one this year to quarter one previous year and so on. But I'm making a more fundamental point, Avan. I am saying, yes, demand is picking up. And as I said, this year, Q2 will be better than last year, Q3 will be better than last year, Q3. No doubt about that. If you look at past, it will be incremental improvements. The more fundamental point I'm trying to make is that sometime in the next 2 to 3 years, as has happened in every country that has moved towards $3,000 to $3,500 per capita from $2,500, which is where incidentally India is today, there has been a structural shift in demand. So it is no longer 1.4 times the rate of growth of GDP. What really changes is that with that shift in GDP per household or GDP per capita from 2,500 to 3,000, the number of people who move into $7,000 per capita or more, which is at one point of the bell curve, that grows exponentially. It does not grow at the rate of GDP growth, which is 6%. It grows 25-30% a year. So what happens then is, in the early stages, luxury takes off. So because look at India. Today, India has only 1 million households or a little more who earn more than $100,000 a year, and about 3.5 to 4 million households who earn more than $35,000 a year. These are actual stats. But when GDP per capita hits $2,500 and moves towards 3,000, which normally takes 2 to 3 years, this 1 million will become 4 million. That means there'll be a 4x growth in the number of people earning over $100,000 per household. The $35,000 to 100,000, which is say 3.5, 4 million people, will grow to 20 million.
Right.
That is again 4x growth.
Sure.
So it's a hockey stick.
Right, Mr. Keswani, I just want to understand as well in terms of just for Lemon Tree in particular, analysts are talking about how FY25 is really going to be a game changer for Orica near the airport, and they're talking about very healthy revenue growth, 300 odd crores, looking at very strong occupancy and ARR. What are you working with?
All this is fine. This will happen. But the point I'm making to you, Avan, is markets look quarter to quarter, right? But the more fundamental point I'm making to you is these improvements will continue to happen quarter to quarter. And then suddenly the market will see, and I'm not talking Lemon Tree only, I'm talking the hotel industry. The market will suddenly see a spurt in demand for hotel rooms on a sustained basis over 3 or 4 years, where the demand will grow so rapidly that supply will definitely not be able to catch up. So we are talking two different things. I'm saying, yes, we will do better every quarter, but I'm saying the industry will do phenomenally in the next 4 years.
No, I understand that, and I'm trying to get out numbers from you, and I'm trying to understand a little bit more about your business. That's why I'm, probing on the numbers. So
the numbers, I don't give guidance. What I can say,
but you're talking about projections, yeah.
But I'm saying that, I have said, and this is not unpublished price-sensitive information. I have said before that we will have at least 15, hopefully at least 15, but maybe even 20% annual growth in revenue. Okay. which means an at least equivalent growth in EBITDAs and a much higher growth in profit after tax. But that is, again, you are talking 1 year, 1.5 years with me. I'm talking 3 years. And I'm trying to say, as an industry, and definitely Lemon Tree is a part of the industry, we are on the runway to really taking off, which is something international investors are seeing, by the way, sadly. But the domestic market is not recognizing yet.
Okay. Now, given that that may also be aided by the fact that you have, you earlier had an asset-heavy model where you owned hotels. Now it's more management contract. Is that really helping? How is that helping your overall inventory, and how is that translating into earnings growth for Lemon Tree?
So as I already told you, earnings growth will be north of 20% a year. Okay. This is assuming regular growth, which is, at least 15% revenue growth, some increase in expenses, and the flow through will be directly towards EBITDA and PAT. Our future growth will come through asset light because we want to increase our network. But the way we look at it is very simple now. There are 5 high frequency indicators that I look at for the hotel sector. And it helps in our strategic planning of where to put up our flag and where should we look at managing more hotels. So I think the high frequency indicators one would look at would be, what is the rate of growth of airline passenger seat in the next 5 years? So what we know is that the 3 airlines, the Tata Airlines, Indigo and Akasa, between them have ordered 1.5 times the number of planes that are already in India today. And I'm reading that this may go up to 2.5 times. What does it tell you? It means the number of airline seats in the next 4 to 5 years is going to grow at least to 3x of what it is today. So the question is now, and airlines are smart buyers of aircraft, obviously. Where is this traffic going to go? Then you link it to a second thing, which is India has 150 airports. There are another 100 airports coming up. So where are the next lot of airports coming up, and in which airports which exist today are additional runways being added because of anticipated increase in flights into those cities? Third is, where is the maximum 4-lane highways coming up? Just FYI, in the last 4 to 5 years, the number of 4-lane highways in India has doubled.
Okay.
So where are they going? Where are these highways improving connectivity to? Next is SUV sales, because typically SUV sales, whether it was China, Indonesia or other countries, whenever SUV sales took off, it meant that more families would travel on those SUVs on better roads to driving time within 4 hours of their cities. So when you put it together, you get a fairly clear map as to where likely demand is going to be. And when you ask me where do we want to go, obviously we want to go to those markets where we don't have enough inventory, where we see this growth and demand.
Okay, and what about the room addition plan? You've been very aggressive when it comes to your Capex plans. Tell us a little bit more about what your Capex plans are and what the room and hotel addition plans are.
So again, as I have stated in our investor presentation, our last major investment was in Aurika, Bombay of about 1,000 crores. Now we are digesting that. We think we will have a large amount of free cash flows. So the question then will be, this is our joint venture company with a Dutch pension fund manager, where we have many of our assets, where we own 60%. So the question will be, when this company has finished building all these assets and starts generating plenty of free cash flow, should we deploy this in asset creation or should we simply return it to shareholders? So that's really a board decision. It's not that I want to put up assets. It is more that we will put up assets as a company in this joint venture where we have a minimum hurdle rate of return. And if we can achieve that, then we will put up assets. Otherwise, we will simply find ways to return that money to shareholders, whether it's through dividends, share buybacks, or what it is. So growth needn't be asset heavy. But if an opportunity comes where it makes sense, then sure, we'll be looking at building or acquiring a hotel there.
Okay, and you're also looking at operating and managing hotels overseas. So, how are the international plans shaping up? New York, London, Singapore?
That is for the future. An interesting statistic, I don't know if you are aware of, is that when 11 million foreigners came to India, and these include a lot of NRIs, 26 million Indians went out of India. So here's the funny statistic: the number of people we get from outside, 2.5x of that are Indians who fly from India outbound. So obviously, as we grow our network in India and our loyalty base, we would like to offer our loyalty members options of stay in the top 10 markets in the world where they visit. And by the way, this 26 million Indian number will actually triple in the next 4 years, 5 years, which will be a part of the rate of growth of GDP. So we will look at it, but it will be an asset-light growth, which means we look at managing hotels in these markets. I think in the next 2 years, we're going to open, I'm not sure the number, but 3 to 4 hotels in Nepal, for example. And we will similarly look at these other markets where Indians go.
Yeah. And you've spoken extensively about how there's a big boost, you're going to grow well. What about the government's focus on the tourism sector? How have you read into that? What about corporate travel, all reaching pre-COVID levels, I assume, or exceeding?
So I would say now finally, within the domestic sector, we have reached the pre-COVID levels. But international travelers are still not what they were pre-COVID, and I reckon that might happen by the end of this year, that our run rate will hit that. Domestic travel, I think if I split domestic travel also into segments, then there is clearly a growth in leisure, specifically religious. I think there is a degrowth in certain corporate sectors like IT and so on, where companies are announcing slowdowns in hiring, which tells you that the number of employees they have on their payroll vis-a-vis pre-COVID is actually less than what it is. So those are not going to be significant, or let's put it this way, the same level of demand generators as they were in the past. So this is there are many balls in the air, but on an aggregate, I would say demand in India is kind of back to pre-COVID.
Okay, and finally, you've been at the helm of this hotel for quite some time. You're a veteran when it comes to the hospitality industry. What are your pearls of wisdom for running a business such as this?
Hotels?
Yes.
I think the fallacy, I see that a lot of people say to be an entrepreneur, you have to be a risk taker.
Yeah.
To be a successful entrepreneur, the first and foremost is that you must earn before you burn. So my view is that you must be a great risk avoider, not taker, but avoider. Because you start a business, there is risk. You must learn how to mitigate it or preferably avoid it.
I love that, to be a risk avoider rather than a risk taker. Mr. Keswani, what a pleasure it's been interacting with you. Thank you for joining us.
My pleasure.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.